Welcome back to X&Y Trading, where 27 years of real-world experience in global markets guides every piece of analysis that we bring to you. Today we're diving into the latest fundamental drivers moving the Forex markets. Specifically, we'll be focusing on the euro, which faces both strong long-term tailwinds and short-term headwinds. So let's break down what's going on. First up, the big picture. According to analysts at BNP Paribas, there's a growing potential for euro strength linked to a rotation out of U.S. assets. They highlight that institutional investors are increasing their currency hedges and reducing their exposure to the U.S. dollar. We also noted that the market is pricing in a potential peak in U.S. interest rates in June. This suggests that some of the bullish sentiment priced into the USD may already be factored in, and a rotation away from U.S. assets into euros could drive the EUR-USD exchange rate higher. In fact, HSBC upgraded its long-term forecasts for the EUR-USD pair, lifting its end 2025 target to 1.15. Their analysts cite improved macros and a possible reversal of dollar overvaluation as reasons for the upgrade. In our last video, we highlighted that the euro has room to appreciate due to undervalued status based on purchasing power parity. If this is starting to reverse, it could signal more upside for the euro. All of this comes as the EUR-USD pair is trading around 1.13 to 5. Even with short-term headwinds, the longer-term structure remains constructive for the euro. Let's take a look at the technical outlook. The euro's technical indicators remain favorable despite recent pullbacks. This suggests that the bullish trend is intact and that the pair could resume its uptrend once resistance is broken. The immediate resistance level is around 1.137, which also happens to be the level of the 50-hour moving average. This level initially capped gains following the release of Eurozone GDP data. Speaking of data, how did the latest releases impact the euro? Well, not very much. Surprisingly, Eurozone gross domestic product rose by 0.3% in the first quarter, surpassing the 0.2% growth predicted by economists. However, this positive news failed to boost the euro. The currency briefly rallied, but quickly gave up its gains as traders digested the data. On the other hand, the US GDP data came in at an annualized rate of 1.1%, lower than the 1.2% expected by economists. While this may seem like a negative surprise, the dollar didn't immediately react, as the data also showed resilience in consumption and the job market. As a result, the EUR-USD fell as renewed demand for the US dollar took hold. Traders also digested recent inflation data showing a further cooling of price pressures in Germany, France, and Italy. While low inflation is generally seen as positive for the economy, it poses a challenge for the ECB, as it may limit their ability to raise interest rates. In fact, the market is pricing in a pause in rate hikes after the next meeting. This was confirmed by ECB board member Kazaks, who recently stated that the next move will most likely be a hike of 25 basis points in July, and that further tightening will depend on incoming data. The softer-than-expected inflation readings may explain why the euro dipped to 1.1370 during the European session, signals a potential loss of upward momentum for the currency pair. So in conclusion, the immediate driver for the EUR-USD exchange rate appears to be shifting back to the US dollar, with renewed demand pushing the currency pair lower and dampening optimism over the euro's future growth. For now, the balance of risks seems tilted towards the downside, at least until the next ECB meeting. If you're a day trader looking for a short-term setup, you might want to watch this pair closely for any signs of a breakout. In that case, the most likely scenario would be a move back towards the 1.1280 level. But remember that these short-term outlooks can change quickly, depending on global risk sentiment and U.S. economic news. To wrap things up, this week is packed with important data releases that could shake up the markets. On Wednesday, keep an eye on U.S. inflation data. On Thursday, it's the jobs report. And on Friday, another inflation report and China's official PMI data are set to drop. These releases could influence central bank policies and affect exchange rates. Stay tuned for our analysis. At X&Y Trading, we aim to empower you with the knowledge and tools to navigate today's dynamic markets. Remember, the markets are constantly evolving. Stay nimble, stay informed. Thank you for tuning in. If you found this video helpful, give us a like. And if you haven't already, subscribe to our channel and click the bell icon. You can also connect with us on social media. We've got daily forecasts and ad-free, sponsor-free content waiting for you. See you in the next one. Until then, take care. This content is for informational purposes only and does not constitute investment, legal, or tax advice. It has been prepared without considering the specific investment objectives, financial situation, or particular needs of any specific person who may receive this content. Past performance is not indicative of future results, and trading foreign exchange on margin carries high level of risk and may not be suitable for all investors. The high degree of leverage can work against you as well as for you. Before deciding to trade foreign exchange, you should carefully consider your investment objectives, financial situation, level of experience and risk tolerance, and should determine whether trading foreign exchange is appropriate for you. You may also wish to seek advice from a qualified financial advisor. Remember, at X&Y Trading, our mission is to help you avoid the common traps and seize the profitable setups the market hides in plain sight. Stay sharp. Trade smart.